title of my presentation today is The Bearish Bull. Not because that describes me, because if you read me the last 18 months or so, it seems like I'm always bearish. I'm always too cautious and conservative. But the bearish bull, I believe with the gold market, we're kind of in that situation where, I hate the whole, are we in a bull market, are we in a bear market? The bear market ended January 2016, but the bull market, maybe it won't really start until 2018, so that's something that I'm thinking right now. Obviously, as time goes on, markets change and trends can change, but that's how I see things right now. And let's start off looking at gold and silver, and these are just weekly line charts. The moving average there is the equivalent to the 40-month moving average, which is, if you look at gold on a monthly scale, going back 40, 50 years, the 40-month moving average has been really significant. And so we kind of were above it, and if we were really in a bull market for gold right now, gold would have held above that moving average. It probably would have rallied up to 1350 and then come back kind of based around the low 1200s. Just with the way they're trading, look at silver, which looks awful. Granted, it's really oversold. It's probably going to rebound and consolidate for a month, maybe even 2 months. But looking at silver, if it loses that blue support line there, then it's probably headed for a retest of the lows. I'll get to silver later to cheer you up, something positive about it. But for now, it's just silver looks terrible. And gold is holding up well, but if you look at the gold stocks right now, they've probably already priced in 1180 gold and maybe a little bit lower than that. So gold, gold's strength is really a lagging indicator right now. I wouldn't pay too much attention to that. I think gold's going to test at least 1150. And if it loses 1150 on the monthly chart, then there's strong odds that it's going to retest the low at 1050. And the reason why, people say, oh, well, he's just a chartist. He doesn't look at fundamentals. Actually, I do look at fundamentals. As we know, and I've talked about this every time I've been here, gold is driven by real interest rates, specifically falling real interest rates or negative real interest rates. And it's hard to see, but real interest rates have started to rise. And you can see that on the very end of the chart, which shows the last couple months. And the reason for that is inflation has peaked. The CPI, I think, got up close to 3%, but it's peaked. It's starting to come down. One reason for that is energy prices. And then with interest rates, which I'll get to, interest rates they're not falling yet. They're pretty stable, still kind of rising. So that combination is a real negative for gold and precious metals right now. And that's really the fundamental driving force why these charts look so negative and why the trend is down. And commodity prices, they can be a proxy for inflation, but they're rolling over. We already looked at gold and silver. On the top there, I have an equal weighted CRB. I hate the CRB the way it is now because it's like 75% energy. It's just ridiculous. That's an ETF there on the top, but that's an equal weighted commodity index. It's actually the old CRB pre-2005 where it was nicely balanced between all the commodities. And you can see there it's rolling over. It's lost a key level, so that looks like it's going to retest its lows. Oil, meanwhile, a lot of really smart people that I know are shorting that and have done well so far. And oil has, if you look, it's kind of consolidated for quite a while since its initial bounce. So oil is a threat to definitely go a lot lower. Copper looks better than all of those. It's holding up well, but it could come down to that support and test that moving average. And if most of the metals are going to do a double bottom, retest their bear market lows, then copper probably does that as well. But again, commodity prices are a proxy for inflation, and these charts are telling you inflation is coming down right now, and it's threatening to continue to do so in the months ahead. And so let's get to the other component of real interest rates or bond yields. And so we have the 2-year yield, the 5-year, and the 10-year yield. Well, I don't need to read those out. I think everybody here can probably read, at least most of you. Sorry. Too easy. But if I've highlighted these, and gold is more, it's obviously correlated to negative real interest rates, but it tends to be more correlated to shorter term interest rates. So looking at the 2-year yield, which can kind of be a proxy for the Fed funds rate, the 5-year yield, let's focus on those. I mean, if you look at the 2-year yield, that's a strong chart. I mean, that looks like it's going to continue rising. And with the 5-year yield, I mean, maybe that won't make a new high. We'll have to wait and see. I mean, maybe it makes a new high and it's a false new high. But if you look at those and you consider the Fed, I mean, we already have one hike priced in. They're probably going to hike again in September. And if they can hike again after that, I would think that that pushes out gold's bottom towards the end of the year. Now, if I wanted to be more bullish, or if you want to be more bullish, the case to be made would be the last hike is going to be June, and the economic data is going to get real crappy, and that's going to put them on hold. But for now, interest rates are still rising. I don't think it's going to be sustainable if they keep rising for another quarter or so. But they're rising for now, and inflation's coming down, and that's the negative fundamental picture for gold right now. It's not good. And also, I mean, this is something I've talked about in a recent public article, and I talked about this in my book. It doesn't always happen, but right now there's a strong negative long-term correlation between the stock market and precious metals. And it looked like it was going to change a little bit there in 2016, but since then what's happened is the stock market has continued to make new highs, and now it looks like precious metals have made a lower high. So the negative long-term correlation is still intact. And as long as the stock market continues to rise, that means the economy is probably okay for the time being. And with the market rising, the Fed obviously wants to raise as much as they can to get ready for the next cycle. So that's why a rising stock market is going to lead to higher short-term interest rates here in the short to medium term. And so that, I mean, that's why, that's the fundamental reason why the rising stock market is bad for precious metals, and you have that negative correlation right now. But to look at, I mean, so what needs to happen for gold and the rest of the resource sector for this bull market? I mean, call it a fledgling bull market, or say we're in a bull market, but it's having a long pause. What needs to happen for it to really be reignited, for it to go and then keep rising, and not just fizzle out like what's happened in the last year? And in this diagram, I mean, this is just subjective. This is not objective analysis. But if we get stock market weakness, then interest rates will probably top out. They'll start to weaken. That's good for gold. Then if the stock market looks like it's threatening to go into a bear market and the economy's threatened to go into recession, then the Fed probably stops course. That's good for gold. Then gold would probably bottom around there at some point. Then the Fed would probably cut rates. Then you have fiscal stimulus. The next expansion, fiscal stimulus, is going to be like government spending, infrastructure spending, not just in the US, but all over the world. That's going to be the driver. It's not going to be monetary policy. But before that happens, before Congress will push something through, we obviously need some kind of a crisis, or we need some real economic weakness to force all of them to act and push something through. And then, you know, gold always leads commodities, so we'd see gold make the next low first and commodities would follow. But these are some things to keep in mind as to, you know, what could really trigger, you know, the bull market to be reignited again. And so looking at metals prices and the potential for a double bottom, let's just remember where we came from with respect to gold stocks in the bottom in January 2016. Again, I don't need to read all this for you. You guys can read. But I mean, we're talking about literally, I mean, in 10 or 20 years, we're probably going to look back and talk about how the 2016 low was just extremely significant historical low in the gold stocks. So I mean, we're not going back, I mean, we're not going all the way back down. We're not going to new lows. It doesn't make any sense. I mean, I'm going to get into one comparison here. Look at what happened with banks and housing from 2009 to 2011. There's some similarities here where They obviously had horrible bear markets, the worst bear market since the Great Depression. They had a really strong rebound off the 2009 lows, but then they did nothing for like 18 months. They went sideways. They even trended lower. I've highlighted it there. And you can even see the support lines that I drew. Even when these markets broke the support lines, someone like me would probably get in there and say, oh, well, this is broken support. It's going to go back down to the lows. And yeah, that makes sense, but you have to remember, if you're coming off a historic, horrible bear market, in the case of the gold stocks and resources, something that lasted 4 to 5 years, there's just not enough sellers left. The big money is not shorting anymore. They're out of the market. So there's not enough selling power. Even though the chart may tell you that it's going to go a lot lower, there's not enough selling power to drive the market that much lower. So if this happens with gold stocks and we see them breaking the December lows and those types of levels, that to me is a buying opportunity based on all this historical analysis. You may get in there and buy a little bit too early, but that to me is a buying opportunity. And I mean, just back to the point about the 2016 bottom and how oversold the sector was. If you look at just the gold industry in general, here we're looking at some proxies I use to measure the margins of the gold producers, like looking at the gold-oil ratio, because oil is a big cost for open pit mines. I like using gold against foreign currencies a lot. Most companies are not operating in the U.S. I mean, if you're operating in Canada, your costs are in the Canadian dollar, so gold against the Canadian dollar is important to you, et cetera, et cetera. But if you look at and also gold against industrial metals, I kind of use that as a proxy for other industrial prices or costs that are involved in mining. And if you look at all these ratios, the worst was really over in 2014, 2015 as far as the fundamentals for the industry. And this is, I mean, I could do a whole presentation on this, but I just have a couple slides. But this just shows the aggregate net debt of the, I guess it's called Tier 1. I call them the senior miners. But you can see the aggregate net debt has come down. The financial situation has improved. I mean, they have the 2017 estimate there. I mean, if I'm right about the market, that will probably be a little bit higher. But still, the industry is in much better shape to handle lower prices for a couple quarters if it does happen. So fundamental, even if gold comes back and does a double bottom, one, you have to look at where the valuations were in 2016, and secondly, you have to look at the fundamentals of the overall industry, and they wouldn't get that much worse if metals prices came back down and did a double bottom. And I mean, even the junior companies here, you can ask them. I'm sure drilling costs are not that expensive in most places. Their access to capital, right? Even if gold, again, even if we do a double bottom, their access to capital right now is probably better than it was a couple of years ago. So now for some good news. Now, even silver here, as I said, it looks like crap. It's probably going to come back to $14, or at least there's a strong risk of that happening in a double bottom. Maybe silver even goes a little bit below and makes a false new low. I don't know. I'm just telling you about probabilities here. But silver has had 3 bear markets in the past that lasted 6 years. And I'm measuring the bear markets here in terms of time because I'm cutting them off where, when did the next bull market really start? I mean, for example, if a market bottomed at $5, it went to $5.05, and then it just sat there for 2 years, I mean, that's not really a bull market. That's not really, I mean, you could say it bottomed in terms of price, but it didn't bottom in terms of time. So that's why here, cutting these off, when did the next bull market really start? And I just put in today, how after these 3 bad bear markets, how much did silver rally? 92%, 64%, 94% in about a year. So it sounds horrible to say, well, silver could do a double bottom. It's going to go to 14 or 13. Maybe it makes a bottom towards the end of the year. But if you look at this history here, I mean, silver could be, if it follows this, we're talking about $24, $25, $26, maybe $27 silver at the end of next year. So keep that in mind. I mean, this is when the bull market in resources really takes off. This is what could happen just with silver specifically. Again, not a good picture right now, very bearish for the next several months. But after that, there's potential for it to be super bullish. Okay. And so here's looking at this chart of gold stocks, GDX and GDXJ. And we know GDXJ with the rebalancing, I mean, it's not really a junior ETF. I mean, there's companies in there with $1 billion market cap. I mean, when you see a company with $1 billion market cap, do you think junior in any way? I mean, it's ridiculous. Anyway, I digress. So looking at the miners here, in the really big picture here, last 5 or 6 years, if you're looking at the chart, they're still basing and bottoming. I mean, I was hoping that we would see the recent rally, that they would go up to the February lows, that we would see GDX get up to 26 again, but it petered out in the mid-24s at the 200-day moving average. So these look like they're going to continue to come back down. Over the next week or two, there's a good chance we're going to see a decent bounce, but I think we're setting up for a better rebound in the summer, maybe sometime in June, maybe early July. And look, if you want to be more optimistic, then that could be a significant bottom where we could see a rebound and things will keep going. I'm not sure that's going to happen yet. I think that's more likely to happen towards the end of this year. But again, if the economic data gets really crappy in the summer, that would be a catalyst to see gold stocks do really well in the second half and not just at the tail end of the year. So I think it's possible that the miners are going to test the December lows and probably go a little bit lower than that. But again, if you're thinking that's a breakdown, it's really not. It's a buying opportunity if that happens. And I mean, I do so much technical work that people don't think I do any fundamental work, but in my I'm touting myself here, but in my service, so I do all this technical work, but with respect to junior companies, I do fundamental analysis of those. I'm very cautious and conservative about what I buy. I'll be less so when it looks like we're coming out of this low at the very end of the year. That's when we can buy silver stocks, optionality plays. As far as where we are right now, forget about those. I only own one silver stock and one optionality play. But these things right here, this is everything that I've bought since the beginning of the year. And so I'm very cautious about what I buy. I mean, I think I've only done one buy in the last couple months, and that's the one that's down 1%. What? Well, I'm not showing you what I bought. I'm very. These are just all right. I mean, well, you have to subscribe to take my word for it. And these numbers, they're probably low. I should say probably, they will be lower this weekend in the update. But I want you guys to know that I do a lot of technical work, but some people have said picking stocks, that's actually more of a strength, but whatever. I have, okay, this is the last slide. So if you go to the link below, that's $99 for a 6-month membership. I don't want to hear people say, I mean, literally, I'm almost giving this away. I don't want to hear people say it's too expensive for me. Okay, unless you're only investing $500 or $1,000, okay, that makes sense. Come talk to me. Maybe I'll give you an even bigger discount. But I mean, come on. Even if you're investing $10,000, $20,000, $25,000, or $50,000, don't tell me it's too expensive. I can't afford the service. On that note, the last thing I'll say is you want to buy weakness and buy value. This is not a time to be chasing momentum and strength. So, do your research, make your list of companies, find the ones that you like best fundamentally, and if you're really confident in your analysis, buy the weakness, buy the value there. Don't chase the ones that have already gone up a lot. When it looks like the sector, maybe hopefully next year, when it looks like the sector is going to start to make a breakout move, that's when you can be more aggressive with buying strength, buying momentum. You don't want to do that here. For this year, you want to buy weakness, you want to buy value, and I think we're going to get a chance probably in the middle of the summer. And with that, looks like I went a little bit over. And with that, we'll get to the next presentation, which is a company presentation.